Most investors ask, which ETF or unit trust should I buy? But the better question is, what is my system to buy, take profit, and switch when the evidence changes? This video is for education only. It is not financial advice. Investing involves risk, and past performance does not guarantee future returns. Many people lose money in funds not because funds are bad, but because they buy the wrong fund at the wrong time for the wrong purpose. Before choosing a fund, decide the job of the money: short-term safety, medium-term stability, or long-term compounding. Short-term money, needed within 3 years, should focus on capital preservation, not maximum return. Suitable choices are money market funds, T-bills, fixed deposits, and short-duration bond funds. Avoid equity, sector, and thematic funds for short-term goals. Long-term money, 7 years or more, can tolerate volatility because time gives compounding room to work. Medium-term money sits in between. It needs growth, but also defense. Balanced and multi-asset funds can fit here. A practical portfolio has 2 parts: the core for long-term compounding and satellites for opportunities like sectors, regions, gold, or themes. Core funds are broad and diversified: S&P 500, global equity, total world index, global bonds, or balanced funds. Satellite funds are more tactical: China, India, semiconductors, technology, gold, REITs, healthcare, or energy. When picking a fund, don't just look at returns. Check cost, benchmark, risk, drawdown, fund size, liquidity, and consistency. For ETFs, check expense ratio, tracking difference, bid-ask spread, AUM, index methodology, currency, domicile, and whether it is leveraged or synthetic. For unit trusts, check sales charge, annual fee, fund manager tenure, mandate, turnover, benchmark relevance, and 3 to 5 year consistency. The highest return fund last year is often the most dangerous fund this year if everyone is already crowded into the same story. China and China Internet funds looked powerful in 2020 and early 2021, especially after the pandemic rebound. But after peaking around February 2021, broad China ETFs fell roughly 60%, while China Internet funds fell about 80% from peak to trough. Some China funds later recovered from the bottom, but many remained far below their old highs years later. The lesson is simple. Regional funds can stay weak for years. Don't treat them as risk-free long-term core holdings. The S&P 500 tells a different story. It had drawdowns, including a sharp fall in 2022, but long-term compounding remained powerful. For broad core funds, the usual strategy is not constant switching. It is adding, holding, and rebalancing. Gold ETFs can do nothing for years, then suddenly shine when inflation, currency, or geopolitical risk rises. Gold is useful as a hedge, but if a 10% allocation grows to 20%, trim it back. Semiconductors are the opposite example. A sector ETF like SMH surged massively with the AI and data center boom. But even SMH had a major drawdown before the big move. A great sector can still fall 40 or 50% in a bad cycle. Sectors take turns. Technology, gold, energy, healthcare, China, and semiconductors do not all lead at the same time. The market is a relay race. Leadership passes from one sector to another. Your job is to notice when the baton moves. Build a watch list. S&P 500, technology, semiconductors, healthcare, energy, financials, China, India, gold, REITs, bonds, and cash. Once a month, rank your funds by 3-month, 6-month, and 12-month performance. Then compare them against the broad market. A simple rule: only consider funds above their 10-month moving average. This helps avoid catching falling knives. Don't buy because the story sounds exciting. Buy when price, trend, and relative strength confirm the story. One practical model is 70% core, 30% satellite. The core compounds. The satellite rotates into stronger opportunities. A conservative investor may use more bonds and cash, and only 10 to 15% in satellite funds. An aggressive investor may use a larger satellite sleeve, but must accept bigger swings and stricter exit rules. Buy when the fund fits your time horizon, passes the quality checklist, trades above trend, and shows improving relative strength. For core long-term funds, dollar-cost averaging can reduce the pressure of picking the perfect entry point. For sector and regional funds, enter in phases. Don't commit the full amount on the first signal. First profit rule: rebalance. If a fund grows far above its target weight, trim it back. Second rule: milestone trimming. After a big gain, take partial profit, but keep a runner if the trend remains strong. Third rule: trend break exit. If the monthly trend breaks, reduce exposure instead of hoping. Switch funds when leadership changes, the fund underperforms its benchmark, fees are too high, or the fund's mandate changes. Don't switch because of one bad month, social media hype, boredom, or panic after a correction. If a China fund drops below trend and underperforms global equities, switch or reduce. Re-enter only when strength returns. If semiconductors stop leading and healthcare or gold becomes stronger, rotate the satellite sleeve, not the whole portfolio. The fastest way to turn a good fund into a bad outcome is over-concentration. Never let one theme control the whole portfolio. Score every fund from 1 to 5 on cost, performance versus benchmark, drawdown, consistency, liquidity, and suitability. A fund with the highest return but high fees, high drawdown, and poor consistency may score worse than a steadier, lower-cost fund. Review monthly for tactical funds, quarterly for portfolio allocation, and annually for long-term strategy. Rules-based switching is not day trading. Too much switching increases costs and mistakes. Each month, update your watch list, rank momentum, check trend, review allocation, trim overweight winners, and switch only when rules confirm. Profitability is not guaranteed. The goal is to improve your odds through selection, timing, risk control, and discipline. Match the fund to the time horizon. Use core funds for compounding, use satellite funds for rotation. Take profit systematically. Switch when evidence changes. You don't need to predict every boom. You need a system that rides strong trends and protects you when the trend ends. If this helped, save the checklist and use it before buying your next ETF or unit trust.